Is a 30-year mortgage a bad idea?
Is a 30-year mortgage setting you up for financial success, or is it one of the biggest money traps ever?
Most people think it's a bad idea because of the high interest costs, but is it? Or is it a key to building wealth?
We're going to find out today. My name is Trisha Gonzalez with the St. Real Estate Group.
I'm Carla with New Wave Lending.
Let's get into it. Let's break down the pros and cons. So let's start with the basics. The 30-year mortgage is the most popular loan program in the US because of what? Lower monthly payments.
Yeah, exactly. It keeps the payments affordable. Here's an example. So let's say a 400K house at a 7% interest, the monthly payment in a 30-year loan is around $2,660. In comparison to a 15-year loan, that monthly payment goes up by $1,000 a month. A few key points to keep in mind about the 30-year loan. So one, it keeps your monthly payment affordable. Two, you can actually not be house poor. And three, it has tax benefits. So at the end of the year, usually you get a tax form called 1090 days, and you can deduct some of the mortgage interest in your taxes.
Absolutely. So a 30-year loan gives you breathing room, but let's talk about the downsides.
Yes, so the downside about a 30-year loan is the interest. So for this example, 400K home, you're almost paying $550,000 in just interest. That's a lot of money. Compared to a 15-year loan, you can pretty much half that interest cost.
So some of the key points and takeaways are your payments double in interest over time. You take longer to build equity, and you have the psychological hardship of being in debt for 30 years.
Yes.
So Carla, if you want to build wealth, is the 15-year note better?
Not necessarily, and that's when things get interesting.
Here's what most people don't talk about. You don't have to take 30 years to pay off your 30-year loan. You can work at strategically to pay it off sooner. It financially benefits you.
So here are some key points to understand. One, you can always make an extra payment that lessens, basically you pay the mortgage faster. Two, you aren't locked into high monthly payments. So if you get a little extra cash that month, you can bonus, you can always apply to the principal, and you can use that extra cash to invest.
Absolutely.
And this is where real estate becomes fun. So instead of paying or focusing so aggressively and paying the mortgage, how about you save that money and buy a second property with another 30-year loan? So here's the plan. Hear me out. So one, you use that extra cash, save it, buy another property with a 30-year loan. You get tenants with an amazing realtor to pay off your first mortgage. And now you're having someone pay your first mortgage. You get some additional income and you have a new primary home. That's how people build wealth or pay off their mortgages faster.
Using other people's money.
Exactly.
So some key points to take away are your rental property can pay for itself if you've got someone else living in there, and potentially give you a little cushion in that account. Also, your real estate is going to appreciate over time. This is definitely a long-term game plan of what we're discussing. And then third, of course, you're creating multiple streams of income, which we can attest to because Carla does it all the time.
Yeah, so I can definitely attest. I have 2 rental properties, and I started with my primary. It took me 3 years to get ready to buy a second one. Got my second one as a primary, lived there for a few months, and got another one. And both of the properties are paying themselves. I pretty much don't look at that money, but they're in a 30-year loan and they're set to be paid off in 15 years or less. And I'm not doing anything out of the normal or anything that no one else can do. So definitely keep to building multiple streams of income, legacy, and insurance for you, your family, whoever you want to keep it to.
It's not as complicated as we make it out to be buying a second property, especially when you've got a good realtor and a good loan officer that can help you absorb some of those upfront costs or lessen them in any way.
And it is important to also voice that to your loan officer and realtors, because some communities that are very new, maybe they're not ready to be rental friendly right away, or there's also communities that don't like rentals, depending if you're trying to do long-term, mid-term rental or short-term. Definitely the short-term right now, I think nationwide, you just have to be careful because the cities are being a little picky, and also some communities.
If it's something you plan to do, it's definitely something you want to run by your vendors helping you prior to purchasing, so you've got a good game plan in place.
So in conclusion, is a 30-year mortgage bad? Not at all. A 30-year mortgage is actually a tool if you use it carefully. So a few key points to remember. One, a 30-year mortgage, you're not locked in at 30 years. You can always make extra payments to pay that mortgage faster. Two, you can use that to set yourself up as a passive income, so you can use it as a rental. And three, I think one of the biggest things is real estate is the easiest and fastest way to build legacy and to build passive income. So make that asset work for you.
Now we want to hear from you. Are you team 30-year or team 50-year? What is your strategy? Drop a comment below. And if you found this helpful, don't forget to like, comment, and subscribe.
All right. Thank you guys.
Thank you guys.